Welcome to the new Wealth Creation Workshop, Building a Strong Foundation for Success. Today's topic is buying and sourcing mortgage notes. So the most important part of the note business is sourcing mortgage notes, right? Without mortgage notes, we don't have a note business. You're going to get an understanding on how note investors find note product. We're going to go over some sources on how to find mortgage notes. I'm going to constantly talk about taking massive action, basically doing what others are unwilling to do. To succeed in anything, that's how you separate yourself from other people. And then, the key is building relationship with these note sellers. It's the key to the business, but it all starts with creating and building your credibility and your reputation from the start. Everything you do from the start is going to lay down that foundation and really set the tone for who you are in this business. Good communication is the key with everything, with your business partners, with clients, and with note sellers. Word of mouth is very powerful in the note business. A lot of the bigger note investors, the players, we all know one another somehow, some way. Word of mouth travels pretty fast in this business, and give you some ideas on how to start building out your pricing criteria. Before we get started, just some quick terminology. Some of it might be beginner stuff, but I just want to make sure we're all on the same page. So we talk a lot about first and second mortgages. The first mortgage is a senior lien on the property. It's the first mortgage that the homeowner took out, and it's that first mortgage that's basically recorded in the county records. It's really when it gets recorded in the county records is what separates a first and a second and even a third. So that's a first mortgage, a second mortgage, a junior lien. It's the second mortgage the homeowner took out, and it gets recorded in the county second. So that's basically what a first and a second is. So when a loan is originated and a homeowner takes a mortgage on, when that note's originated, it's a performing loan right off the bat. So it becomes non-performing when a homeowner they haven't paid on their loan in 90 days. It's now a non-performing note. Non-performing notes have different stages at 90 days, 150 days late, 365 days late, but they're all non-performing loans. And then what I refer to as a reperforming loan is a loan that was originated, it was performing, it then went non-performing. Usually that loan will get sold, and when an investor or a note fund works that out with the homeowner, they do a loan modification, it's now a reperforming loan. So some people will say it's a performing loan, so it is a performing loan, but that's kind of how I distinguish the three categories. So another thing that we want to discuss right now are the two different types of mortgage notes. The first one is a seller finance mortgage note. That's when a seller of a property carries the financing through a created mortgage note between the seller and buyer. The seller usually creates a loan with the buyer, who now becomes the borrower, and the loan is usually created based on the equity in the property, right? The the seller's not actually lending the money out. They're creating this note off the equity in the property. And it's usually because the buyer can't get traditional financing, or it's just a creative way for investors to buy more properties. Borrower now owes the seller of the property a mortgage that the seller created based off the terms of the promissory note. The seller security instrument is the mortgage on the property, and if that new homeowner, the buyer, does not pay, they have the legal means to get the property back through foreclosure. And some sellers will put a deed in lieu clause in there if the homeowner goes delinquent over a certain period of time to avoid the foreclosure processing cost. And then we have institutional mortgage notes. And these are usually what we're talking about. Institutional mortgage notes are originated by the bank. The bank lends out money in the form of a mortgage loan to the borrower. The borrower now has a loan and owes the bank money. The loan will be paid back over time based on the terms of the promissory note. Same thing, the bank security instrument is the mortgage on the property. And if the borrower doesn't pay the bank has a legal means to get the property back through foreclosure. So they are the two types of mortgage notes. All right, so finding the opportunity with the right mindset. There's opportunity to make money in both seller finance mortgage notes and institutional mortgage notes. The same goes for first mortgages and second mortgages, reperforming mortgage notes and non-performing mortgage notes. That's why I love the business. There's tons of ways to get involved and tons of opportunity. Some investors are involved in all of it. I personally concentrate on institutional residential second mortgage notes, both reperforming and non-performing. Like I mentioned earlier, sourcing note product is definitely the key to this whole business and investment strategy. Without it, we just don't have a business. Start thinking about this. This needs to be done constantly. You want to stay aggressive and you want to stay active on it. Put yourself around the right people to succeed in this business. They will help you find product. It's definitely the power of Rob's FIXnotes, the pro membership, absolute amazing opportunity to get access to product. I don't believe there's anything like it on the marketplace that has it combined with the education. Don't get discouraged when you're starting out. Things are not going to go perfectly, but stay at it. Build those relationships with quality people. And when you do that, you will actually benefit from their network and their resources. The opportunity to purchase these mortgage notes, like I said, comes down to your relationships and your network that you build. The right relationships in this business is what creates the opportunity for bigger discounts when you purchase note product. Because we're buying these things at a discount, and the better your network and the better your relationships are, the discounts are going to be better. Understanding the marketplace. If the product comes from institutional bank originated mortgage notes, then how do we get access to it? Why would the bank sell it and not just work it out with the borrowers like note investors do? It's a question I get asked a lot. A lot of people ask those questions when they're first getting started in the business. Banks are not in the business to lend out money. They're in business to collect payments. Banks are not in the business to foreclose on properties and chase borrowers down that don't pay on their mortgages. The amount of money a bank can lend out to the public is based on the amount of money that's been deposited in the members' bank accounts in that specific bank. When a bank has a mortgage loan go delinquent, non-performing, they must keep a certain amount of money in reserves, and that money can't be lent out to the public. That's when it becomes a nightmare. It becomes toxic for the bank, right? The more non-performing loans on their book, the more money they got to keep in reserve, which means they can't lend that money out. The banks don't want to deal with these delinquent loans, non-paying homeowners, and the big thing is they don't want to spend money on the legal to foreclose on these properties and the dealing with actually selling the REO when they get possession of it. There's a lot of cost. It's a long time factor. And also banks, they get ratings. And when they have a lot of delinquent loans on their books, the ratings aren't great. So it just makes sense for them to cut their losses, sell the loans, make some money, write off their losses, and it all helps out with their taxes at the end of the year. The banks sell these loans to hedge funds and investors. They do that, right, to get them off their books. And this is how we get our hands on note product. I learned early on to be successful in real estate, you need to learn how to solve the bank's problems. And that's exactly what happened when the banks had this major problem and investors figured it out. The banks usually will sell these mortgages to bigger hedge funds in bulk because it's just easier for a bank to deal with bigger funds and bigger transactions. These big hedge funds then turn around and will sell some of these to smaller hedge funds. And this is what I call the trickle-down effect. It's the smaller funds then start selling the mortgage notes to investors like us, smaller investors. The notes make their way downstream. Note sellers and resources in the marketplace. So creditable and reputable note sellers. They are the best when starting out. Most people know them and they make it easy. It's not always the best deal or discount when you're buying from them, but it's easy to start. They're easy to find. These sellers have their go-to buyers, but they eventually will get the product out to other people. It doesn't always make the product bad when people pass over it. It's maybe not what they're looking for. It's a cliche saying, but one person's trash is another person's treasure. It's always about the purchase price and working the asset. When I started this business out, we made a lot of money on no equity loans. And that's where I got comfortable buying non-performing loans, even if there's not a lot of equity in the property. Right now, the equity is up. But like I said, I learned this business on a no equity market. I saw the results. There was equity in there, and if there wasn't equity. Like my mentor always says, it's about the purchase price and working the asset. So when you're dealing with these note sellers, some things to keep in mind. Not only do you want to do your due diligence on the actual product, but do your due diligence on the person that's selling the product. Google them, ask other investors, ask people in your network, and see what you can find out. Always stick to your criteria and pricing when you're purchasing it. If you're getting into the business to buy seconds and you're not sure really about first, then maybe stick to it. And when you come up with an idea on what you want to spend, eventually you got to spend it to get the product, but stick to your purchasing criteria and pricing. You always want to execute and fund a purchase when you say you will. You want to build and establish that credibility, like I said, all the time. If something comes up in the due diligence period and you want to say no, just communicate with the note seller. Be honest with them, share with them what you found out. Maybe they will discount it more, or maybe they'd be okay with breaking off ties. It's just all about communication based off what you find. Just always remember, everybody in this business wants to be helpful, but they're busy. So respect their time and don't waste it. Sourcing note product. And when you're starting looking for product, product, build those relationships, ask questions, respect people's time. But at the end of the day, it's a business that you're going to be spending money in. So the better off your relationships are and the more questions you ask, the better off you're going to be with it. The plug here, right? Become a FIXnotes professional member. Get access to the FIXnotes Insiders Trade Desk. It really is an amazing opportunity for new and seasoned note investors. Majority of the note product for sale is direct from a big bank. The trader's desk, a lot of the big product comes from U.S. Mortgage Resolution. Rob manages notes for them. I'm helping them with it, and especially this source. It's an amazing opportunity. The price alone for that whole membership is worth the access to this trader's desk. Hedge funds, big and small. The reality is if you want access to that product, you do need to be a FIXnotes professional member. It's really an amazing opportunity for active note investors. There's other ones out there, and a lot of these funds, their business model may not be to sell, but at some time, these funds need to liquidate when they're closing down their funds. So the more relationships you build and the more you put yourself around bigger funds and bigger note investors, you'll find out when funds are closing and when they do have product. My mentors, they're a big fund. They don't really sell much more, but they're another big hedge fund. And there's a handful of them out there. Bank and asset managers. Now, I've never had experience with this. I've never really called banks, small ones or big ones. People always want to know, does it actually work? But it comes down to the relationships. Mortgage note servicers. There's a lot of the ones out there that we use, and they really don't sell note product. But the more you build those relationships and you talk to different people in the business, all the investors and their funds have their loans with these servicers. People that I'm talking about, anytime they have stuff to sell, they send it to Rob, and Rob puts it up on his insider's trade desk. So it's not only USMR, but a lot of other people that are in the group that are looking to sell stuff. A lot of them don't have platforms to sell stuff, but it's more about relationships you build and eventually, finding out through those relationships who has note product. From your network, you got note conferences and events. Another thing that Rob does being a member is he keeps a calendar of all the different events throughout the year. You can access it that way. You have the Diversified Mortgage Expo, DME, that's in Nashville, Tennessee in May of 2025. Note Expo is every year in Dallas, Texas. That's in November 2025. Paper Source is a big one in Las Vegas, Nevada. That's usually in the spring. And then another really powerful one is IMN, Information Management Network. You can go on their website and they host tons of real estate conferences, events throughout the year, and they have different topics. I know the big one that a lot of us note investors attend is usually in February or March down in Florida. It's a note conference, but they have all kinds of different ones. So there's 4 good ideas. It really is about getting out to these events, meeting the people there, forming those relationships, even, local real estate meetups. I know Rob just presented at big Diversified Investment Group, which is a big one. A lot of us sometimes when we get involved in the note business, we forget about the local meetups, but they're great resources. There's other real estate investors. There's people that may be creating note product through seller finance notes. And if you don't put yourself in these places, you're not going to be able to find a product and form these relationships that you need to. Mortgage note brokers. You have your real brokers and then what we call joker brokers, right? So the real brokers are usually pretty big. They usually sell in bulk. They usually get a percentage from the seller of what they can sell. Good brokers will do their own due diligence and know exactly the product they're selling and actually have information on that. Joker brokers, you want to avoid them. They're, third parties that are passing around a daisy chain spreadsheet that's been passed along. They don't know anything about what they're selling, and they could be selling bad products. So just know the difference between the two of them and avoid the joker brokers. Real estate attorneys, right? All of us note investors use these attorneys, so the attorneys know who the other investors are. And the more relationships you build, the more you can figure that out through those relationships. Some of these attorneys are also note investors. One of my mentors was a trustee. He was an active trustee, but he was also an active note investor. Other note buyers and investors, right? We always forget about this. We're all on this call learning about notes, and we also buy notes. I don't like to sell, but when I need to sell, I need to sell. Just building those relationships with active investors, other peers of yours in this business. I know when I'm selling a reperforming note, I reach out to 2 people and I can usually sell it within that day. And the people that I sell to are 2 funds, and they built that relationship with me. Just start thinking about all these sources that we're talking about and getting ideas on how you can build your business. Mortgage assignment chain. It's a little cooler once you're actually in the business and you're buying product. When you buy from Rob's Trade Desk and it's from USMR, when you're doing your due diligence and you're actually reviewing the collateral, you're going to see the assignment. Now, outside of that, if you buy a mortgage note and there's 3 or 4 assignments, you can look through that assignment chain and see the other funds that have owned that before you. Google them, see if they're still in business, see if they have product. But I've always liked that. Just look at mortgage assignment chains and you'll start getting an idea of who's selling product and who has product. So that is sourcing note product. Let's get into understanding purchase price when you're looking to buy loans. So like my mentor told me early on, there's no bad notes. It's all about the purchase price and how you work them, because we're buying these notes at a discount. So even if it's the ugliest note and you can buy it $100, maybe you'll make something off it, maybe you don't. But that's kind of the point, there's no bad notes. You want to start creating and building your purchase criteria and your pricing charts. It's going to be different for everybody, but you need to start building it so when it comes down to it, you have an idea of what you're looking for and the amount of money that you'll spend on it. Start understanding the difference between time value of money, TVM. I also refer to it as yield. First, your regular investment ROI, rate of return, right? Because in note investing, we're using the concept of time value money yield calculations rather than your standard ROI calculations. And the reason is we're getting our money back monthly, and you can actually reinvest that money, and that's why you can't use the basic ROI calculation. So let's look at the definition of time value of money, TVM. This is the concept that money available at the present time is worth more than the identical sum in the future due to its potential earning capacity, right? This core principle of finance holds that provided money can earn interest, and any amount of money is worth more now than if it's received later, right? Because we're getting monthly mortgage payments back every month, and those payments are principal and interest. But it doesn't matter what the principal and interest is. If it's a $300 monthly payment, over the course of the year, we got $3,600 back. After year 2, we get $7,200 back, and we can redeploy that money into another asset. Maybe we buy a partial, but it's the concept that when you get money back, you can then earn interest again on it by lending it back out or buying something. So I use a 10BII financial calculator. It really is an amazing calculator. It's one of the best financial calculators for calculating yield. You can get the app on your phone for $6. It's hands down the best calculator in the note business. There's 5 buttons on the top that help you calculate your yield. You need to know how many monthly payments you're buying, what the monthly payment is, what's the yield you're looking for. Is it a deferred amount on the back of the loan that you're going to get when the loan's paid off? As long as you have 4 of the calculations, you can come up with the 5th one. So I know I'm buying 300 loan payments. I'm buying a $300 payment. I want a 12% yield. There's no money being deferred on the back end. I can then calculate what I should pay for that loan. Great calculator. I would recommend everybody get it. So when you're buying non-performing mortgage notes, you're buying it based off a percentage of the loan's unpaid principal balance. I recommend never purchase based off a loan's payoff number. So when you're looking off a spreadsheet, you may see a loan balance of $50,000 and the payoff is $70,000. That extra $20,000 are arrearage, owed interest, owed late fees, any owed recoverable legal costs that lenders advance payments, basically they're called. And the reason I recommend not buying it off that payoff amount is during your process of trying to get this loan resolved, maybe something comes up with statute of limitations and maybe you can't collect on the owed interest, or maybe something comes up and you can't collect on the late fees. The arrearage is always a bonus that you can collect on. If you're doing your purchase price based off a $50,000 loan balance or a $70,000 payoff, there's going to be a difference there. I always buy based off the UPB. So in today's marketplace, it looks like non-performing notes are being sold between like 30 to 70% of the loan's unpaid principal balance. I've seen people pay more. I've seen people pay less. It obviously is a very wide range depending on numerous factors, but there's a wide range of them. And between 30% to 70% now, when I started this business, you could buy buy these between like 5% to 25%. Those days are gone. It's a lot different, but there's still plenty of money to be made buying correctly and even buying at 70% of the loan balance. So let's look at some factors that, in my opinion, are the biggest factors when you're coming up with your pricing. What influence 70% when you're buying non-performing mortgage notes. A lot of people forget this one, but in my opinion, the biggest factor is the note seller's credibility and reputation. Who is that note seller? How many notes have they sold? What's their reputation? If we do a transaction and we find out something later on, is that note seller going to be there to help me fix this, or are they going to be MIA and I can't find them? Good quality note sellers will help fix problems as long as they can, because everything happens in this business. A lot of these sellers have clauses in their contracts, but a good note seller with a good reputation and good credibility, in my opinion, is number one. So if you're looking at a first mortgage, you definitely are going to want to know more about the condition of the property than if you're buying a second. When you're buying mortgage notes, you're not going to be able to get inside the property. That's a whole other can of worms to open, but you're basing, what you're going to buy it at based off of the condition of the outside property. Maybe you actually get somebody to go buy the property to do a BPO. They walk around it. They see what's going on in the backyard. And it's not that I don't care about the condition of the property when I'm buying second mortgages, but the more you look into this business and start looking at stuff, you're going to find out that it's kind of weird that non-performing seconds, the property is usually in better condition because there's a homeowner in there, and usually when we're buying these delinquent seconds, we're buying them behind a performing first. That's one of the main reasons I fell in love with this niche, and a lot of us like this niche. Is there's a performing first mortgage, the seller is usually invested in the property. Other liens on the property that need to be addressed, especially property taxes. So when you're buying delinquent first mortgages, there's no other lien in front of you. So there's a good chance that the property taxes are late, there's taxes that are owed, and there may be other liens on the property. It could be mechanical liens, HOA, utilities, and you want to have an understanding of what liens are superior to yours and what liens are going to need to be addressed. Because if you're buying a non-performing first and you need to take this thing to foreclosure sale and liquidate it, some of those liens, if they're in front of your liens, your lien need to be addressed and paid at the sale. There's probably going to be liens that are behind you and get wiped when you foreclose, and that's fine, but you want to be aware of it, especially property taxes. So if I'm buying a non-performing second mortgage, I want to know the status of the first mortgage. Is it a current first mortgage, and is it current all the time? Or is it 30 days late, and is it a rolling 30 days, meaning they're basically current, but for the last 2 years they've been paying 30 days late? Then there's the other category of unknown mortgages, first mortgages. And that doesn't mean that the first mortgage is delinquent. We just are not getting information from the seller, and the seller can't get the exact information, maybe because it's not showing up on the credit report for whatever reason. Borrower was discharged from bankruptcy. Maybe that lender is not reporting. But when I'm doing my due diligence, I can maybe look at some title reports or foreclosure reports and see if that first is in active foreclosure. So maybe it's not in active foreclosure. There's no indication of legal presence from the first, but it's an unknown first mortgage. Gets me thinking, did the borrower go through bankruptcy and maybe it was discharged and now they're not reporting to the credit report? So just some things to think about. The last bucket is the first mortgage is delinquent. Majority of us are buying these delinquent seconds behind the current first. And I want to know 100% the status of that first, or at least have done my homework if I'm buying a non-performing second. And it doesn't matter if you're buying a first or second, what's the property's value and what's the equity in my property that's covering my mortgage note. If it's a $100,000 property and the first mortgage is 50 grand and I'm buying a second for 30 grand, I know my mortgage is completely covered in equity. Same scenario, maybe I'm buying, the property's worth 100, the first mortgage is worth 80, and I'm buying a $40,000 second. All of my balance that I'm buying is not covered in equity. Doesn't mean I can't collect on that, but it's just giving me an idea of what to base my purchase price off of. And obviously that scenario, if the first is 100, I'm now buying it that's not covered in equity. I'm going to be looking to buy that a lot lower than I would be if it's covered in equity. And same thing, even if it's a first mortgage, if I'm buying a $100,000 first mortgage, what's the property value? Maybe it's 100, maybe it's 150, maybe it's 50,000. It doesn't mean I'm not going to be able to collect on that. I just want to have an idea of what that equity is. In that scenario with the first mortgage, even though you bought a $100,000 first and the property's only 50, if you can't collect and got to take that to the foreclosure sale and liquidate it that way, you might not get 100 grand. Maybe you get 30 or 40, and that's why it's really important to know the equity in the property to come up with your purchase price. Homeowners insurance. When I buy non-performing seconds, 95% of the time the property taxes are current and the homeowner's insurance is current. The first mortgage is usually making that homeowner escrow those costs along with their mortgage payment every month, right? PITI, principal, interest, taxes, and insurance. So the first mortgage will make them pay extra every month to put it in escrow so they make sure the homeowner's insurance and taxes are current. Now, if you're buying a delinquent first, there's a good chance that there's no insurance on that property, and that's going to become a cost. You're probably going to have to do what a lot of note investors do. It's called forced place insurance. They get their own policy that's covering them. So just stuff to think about. And then, a big factor is what state is it in? Is it in a judicial foreclosure state or a non-judicial foreclosure state? The cost and the timeline associated with taking a property back in a particular state. The costs are different and the length are different. So you just want to know what your cost is. And if I'm buying non-performing first, I probably even want to know what the cost will be, not only to take it to foreclosure sale, but what happens if the property reverts back to me and I got to go through the eviction process. The eviction process is different if there's somebody in the property or if there's nobody in the property, but there's still cost with the eviction process. So just stuff to think about. There are costs to it. Purchasing reperforming mortgage notes. Once again, majority of my experience is buying reperforming seconds and not buying reperforming first. So don't hold me to something that I may not be 100% clear on with first. Like I said, majority of my experience buying in today's marketplace, it's based off the yield that the note buyer wants and what the note seller is willing to sell it at. What I see in the marketplace right now, reperforming notes are usually selling between 18 to 14% yield. To determine your yield and purchase price when purchasing reperforming note, you need to come up with how many monthly loan payments are you buying, how much is each monthly loan payment. And like when I'm calculating my yield, if it's a monthly payment of $300, I know my servicer is going to be taking $20 a month. So I come up with a strategy of, maybe I'm just going to calculate 290 payments to give myself a buffer, to give me a cushion on cost. Just in case something happens, there's going to be a cost associated with me buying a loan with an IRA company. There's going to be costs there. I got to record mortgage assignments. So by taking payments off to calculate my yield is where I'm taking into consideration my real cost on buying this note. And if there's a deferred balance on the back of the loan, there's the three categories. The other category is the yield that you want to come up with the purchase price. What I consider the biggest factors when you're pricing and what influences that price and when you're buying reperforming mortgage notes. Number one is the borrower's ability to repay the loan. I always want to see a credit report when I'm buying a reperforming loan, even when I'm buying a non-performing second. But anytime I buy a reperforming loan, I want to see what the credit report looks like. Once again, like I mentioned earlier, who is that note seller? What's their credibility? What's the loan modification agreement? What's that package look like? Am I buying just a loan modification or are they including the insurance information? If I'm buying a second, are they including the first mortgage information? If it's a reperforming second, do they have an authorization with the first mortgage company that they can assign to me? If I'm buying this and I'm keeping it at the same loan servicer, is it on ACH payments? All those things make that loan modification package a lot better, and you're willing to buy it at a little less of a yield if that package is strong. Seasoning and payment history on the loan. Now, I personally buy a lot of loans that are just modified, but other investors want to see a year of payments, 2 years of payments. And anytime I'm buying a reperforming loan, that note seller can get the payment history from the servicer and they can show it to you. It's real simple and easy. I always want to have an idea what the property value is. Even if I'm buying a reperforming loan, I do want to know what my equity position is and just have a good idea on that. You can get probably a higher yield. Basically, if there's no equity covering some of your loan, you might be able to get a better deal on that. And then the last factor is what state is it in, just in case. If it goes non-performing and I got to rework it, I do want to know what state it's in just for compliance, regulation. And like I said, if I need to start legal again on this, I want to have an idea. So that is what I have for today. I hope you got a lot out of it. I'm going to open it up. If anybody has a question, just unmute yourself and shoot away. I'll stay a little extra to answer everybody's questions.
What's a red flag that you see for a joker broker? How's a way you can tell somebody's a joker broker if they're the real deal?
Usually if they're selling online, social media, You can look at the tape, you can ask them some questions, and they're not going to know it. It's just one of those things that you'll get that gut feeling right away. But yeah, that's the deal with the joker brokers. They're usually, it's like a wholesaler that's, wholesaling three other wholesalers' deals. They're not really going out to find their own deal to wholesale. And there's money to be made in this. They're taking three other wholesalers' deals. Sometimes they get permission, sometimes they don't, and they'll make a little cut off it. And that's the deal with these joker brokers. Some of them are just passing the tape around and they don't really even know who owns it. I mean, the first question is you can ask who owns the loans to at least see if they're somewhat legitimate or at least even a note investor. But you'll get that gut feeling.
Talk a little bit about how we can make our RPLs more valuable if we plan to sell.
What's your loan modification look like? All the loan modifications refer back to the original mortgage and note. So it does be able to go back to the original mortgage and note for all the legal language and all that stuff. But it's important to know in your loan modification, like what happens if the homeowner stops paying on this. If you have some incentives in your loan modification and they go delinquent, you just want to have that language in there that says these incentives are no longer associated with this since you went non-performing. So, solid loan modification. And it's that package, like I mentioned, if you're buying a reperforming first or second, are they supplying the homeowner's insurance information? Are they actually even listed as lost payee? And usually if you're listed as lost payee, it's and or assigns. So when you buy a reperforming note, you can be listed as lost payee on the insurance policy. Let's say they're not listed as lost payee because they're lazy. Are they supplying you with the homeowner's insurance declarations page so you can then get yourself listed as lost payee? If you're buying a second, are they supplying you with that first mortgage information, like an actual payoff? And are they supplying an authorization that gives you access to talk to the first mortgage lender? ACH is huge. Now, if you're selling a loan and someone's buying it and transferring it to another servicer, they're going to have to get the ACH redone anyway. But if you're buying it at the same place, these reperforming loans, in my opinion, always run the smoothest because there's no RESPA letter. You're buying it, you're keeping it the same servicer, and the ACH just stays in check. To me, those documents, those supporting documents, really make a loan modification package better. You want your reperforming loans at a servicer so you can create that payment history. But I think those types of things is what makes a reperforming note more valuable. Knowing that you're going to sell something, be careful about putting incentives in there that aren't real clear. If you're looking to sell this loan, you're going to give them a $5,000 discount if they make 3 years of payments. Is that going to be attractive to somebody that's buying it? Sometimes it may be, sometimes it may not. So, think about your incentives and what you're putting in there if you're going to sell something.
I actually wanted to ask a little bit more about that. So when you say incentives, do you mean like maybe give the borrower a lower interest rate? What kind of incentives would we be able to kind of fall back on if they do default? I just wanted to understand a little bit more about that. Like what kind of incentives are we talking about here?
So this is a cool case study. This is on one of my non-performings that I just got reperforming. Homeowner was in bankruptcy, paid me like close to 10 grand through the bankruptcy plan, but just couldn't keep the thing moving. So bankruptcy was dismissed. They were paying on their first. He reached out to me, knowing that he had that much money. And I forgot to mention, the bigger the down payment, the more skin in the game for the borrower. So on this specific deal, I only took a $500 down payment because he just paid me 10 grand through the bankruptcy plan. It was more about just getting the payments back on track. Okay, this homeowner owed me about $45,000. Knowing that the payment that homeowner could afford, if I put the 45 grand into a 20-year amortization based off the payment that he could afford, I was going to have to write that mod at 4 to 5%. And I knew I was going to sell that loan. And if to sell something at 4 or 5%, you're going to be selling it at a big discount. I started out, I said, okay, let me just take 12 grand of that and let me just take 33 grand and amortize that over 20 years at 8%. That monthly payment is the same exact monthly payment. If it was amortized for 20 years, a 45 at like a 5% was going to be the same monthly payment as 33 amortized over 20 years at 8%. What I decided to do was I'm going to write this mod up at 33. I'm going to give the homeowner an incentive on the other 12 grand. This incentive is also going to make it stronger when I sell it, because when I sell this note, I'm just basing my sale off the 33. So I basically gave the homeowner an incentive over the first 6 years of this reperforming loan. And it needs to happen for 6 years straight. But for every 12 monthly payments, I will wipe away 2 grand. So if he makes 6 years of on-time payments, I will wipe 12 grand away. If he doesn't do that on time, that deferred amount will be a bonus and it will be there when the loan's paid off. And like I said, why would I give up 12 grand like that? because when it came down to the monthly payment, I was getting the same monthly payment when I amortized 33 grand at 8% than if I did 45 at 5%. And I knew because I was going to sell this, I'm going to get more money if I sell that loan with an 8% interest rate. So those incentives are written into my mod. I express that they expire after 6 years and the homeowner can start over, but if he hiccups in that first year, that 2 grand of incentive is out the door. He can only get an incentive on the last 10 grand. So incentives like that, as long as they're clear and it makes sense, sometimes that incentives will help make your own mod more valuable.
Thank you.
Yeah, absolutely. Great question, bud. Well, awesome. I appreciate everybody. Thankful for FIXnotes. I hope you got something out of it. Wish you nothing but the best and have a good rest of the day. Thanks, everyone.